All right, so we might make a start. So good morning, everyone, or good evening, depending on where you are today. And thank you for joining our webinar on the UK budget, which was handed down by the Chancellor Rachel Reeves on Wednesday afternoon. There's no doubt we have had significantly high interest in this webinar today, and particularly this has been around the announcement of the UK government's changes on the taxation of non-domiciled individuals. Prime Minister Keir Starmer made the remarks a few months ago that this autumn budget was set to be a painful one. So, for months, there's been some speculation and anticipation around the new government's maiden budget, which is also Labor's first budget in 14 years. I'll also add it was the first ever budget to be delivered by a female chancellor. But for today, we're very excited to be partnering with our member, HW Fisher, and we have Adam Bonnel and Daniel Hayward as our guest speakers, who will be unpacking the key headline items of the UK budget, as well as outline more specifically what this actually means for Australian individuals and those doing business here in the UK. But before we get into it, I did want to provide some general housekeeping as well as a bit of a background to the chamber. So this webinar, it will be recorded and made available to you. We'll put it up on our website, and we'll also send a thank you email with the link to this webinar. It will have 45 minutes of a presentation with 15 minutes at the end for some Q&A. And you'll notice that your camera and your microphone capability is switched off. And that is to encourage everyone to use the Q&A function. So not the chat function, but the Q&A function for any questions, which we will answer at the end of the webinar. But yeah, so a bit of a background to the chamber, or should I say the only commercial break you'll get for this webinar. We're a not-for-profit membership organisation with about 150 different members from all sorts of different industry sectors, and also ranging in terms of company sizes. So from the big corporates to small startups and SMEs and some individuals as well. The chamber is led by our CEO, Richard Basil-Jones, and also our chair, Dick Porter. Our offices are located here in Australia House in London, which means we work closely with the Australian High Commission, the Australian State Trade and Investment groups who have offices here as well, and Austrade. So our role primarily is to connect and facilitate and inform our members. And we do this primarily by hosting a range of different events, webinars exactly like this, or events on key areas that directly impact our members. And to give you a sense for it, on Monday, we hosted a small roundtable for our members on mobility and visas around the new Australia-UK Free Trade Agreement. And we had some government officials come from Canberra and talk directly with our members. And later this month, we're hosting a panel discussion on critical minerals. And in December, we're hosting a large young professionals reception, an end of year reception at Australia House, which will see 150 people from their 20-somethings to 40-somethings in the room. So we say if you feel young, we encourage you to be in the room for sure. So, but now back to the important stuff, the UK budget. And I did hear there was some good news for the beer lovers, with the price of a pint set to decrease by a penny. But that's the only fact you'll get from me today, and I'll pass you on to our speakers. So we've got Adam Bonnel, who's partner and head of international tax at HW Fisher, and Daniel Hayward, who is a private client director at HW Fisher. So hand you over to them.
Thank you, Nicole. Good morning, everybody, or good evening if you're in Australia. Thank you very much for joining us this morning. As Nicole introduced, my name's Adam Bonnel. I'm the private client partner here at HW Fisher, and I'm responsible for our international tax department. This morning, we're going to talk about this week's budget. We're going to summarise the key points. My colleague Daniel is going to run through the wider announcements, and for context, is also going to provide some details on the existing non-dom and residency regime. It's quite important to understand that and how that then interacts with the new rules. I see we've got a good mix of attendees on the call, and we will try to cover as much as possible. We will finish up with some Q&As, hopefully field any specific questions you may have. And of course, at the end, we'll share our contact details if you want to get in touch after with any other questions. So on that note, Daniel, if I could pass over to you, please.
Absolutely. Morning or evening to everyone. So I'm going to give you a quick summary of the main talking points that arose from the budget on Wednesday. I'm going to share my screen with you because I have some slides to follow the presentation. Just 1 second whilst I do that for you. Okay, so hopefully everyone can see my screen. Wonderful. So, as Nicole mentioned, Keir Starmer had predicted that the budget was going to be painful, but whilst perhaps not quite as painful as many had led us to believe, the budget did contain a number of tax increases and rule changes which were going to have a significant impact specifically for non-DOMs, internationally mobile employees and investors into the UK. So I'm going to summarise the main budget announcements, which include changes to the following areas: capital gains tax, stamp duty, VAT, inheritance tax and national insurance contributions. As part of the budget, we also received a substantial update on Labour's plans for the taxation of non-DOMs. And as mentioned, Adam is going to discuss these changes during the second half of this webinar. So in this first part, I'm only going to touch on those aspects briefly. So firstly, capital gains tax. As was widely anticipated, both the lower and the higher rates of capital gains tax were increased. From 30th of October 24, the lower rate for basic rate taxpayers is going to increase from 10% to 18%, and the higher rate has increased from 18 to 24%. This was a relatively modest increase compared to the initially feared 45% rate, which would have brought the regime in line with the highest rates for income. The rate applicable to the payments of carried interest would increase from 28% to 32% from April 2025. That's prior to the introduction of a new regime from April 2026. Somewhat surprisingly and refreshingly, there were no changes to the rates applicable for the disposal of residential property, with the lower and higher rates remaining at 18 and 24% respectively. Tax reliefs for business owners and investors were also hit. The historically low CGT rate of 10% for assets qualifying for business asset disposal relief and investors relief were increased to 14% with effect from April 2025, and they will increase further to 18% in April 2026. We also saw the 10 million lifetime allowance for gains qualifying for investors relief restricted to 1 million. This limit takes into account any prior qualifying gains where the relief was claimed and brings that allowance in line with that available for disposals qualifying for business asset disposal relief. So on to stamp duty. Firstly, from 31st of March 2025, the nil rate threshold, which is currently £250,000, will return to the previous level of £125,000. Secondly, individuals who purchase additional residential properties, such as second homes or buy-to-let properties, currently pay SDLT at 3% above the standard rates. This surcharge will be increased to 5% for transactions with an effective date, which is usually the date of completion, on or after 31st of October 24. The increase will also apply for companies and other non-natural persons who are purchasing residential property. Listeners should be aware that the surcharge applies even where additional property is held overseas or is owned by their spouse. In addition, there is also an increase in the single rate of SDLT payable by companies and other non-natural persons when purchasing residential property worth more than £500,000. That's going to increase from 15% to 17%. Thankfully, there was no change to the existing 2% surcharge applicable to the purchases made by non-residents. But together, these changes add further disincentives for individuals with homes already overseas from purchasing property in the UK during their time here, and for inward investment more generally. Prior to the budget, inheritance tax was touted as an area where we might see significant changes. Whilst any changes to the regime are always closely scrutinised, it must be noted that IHT will remain a tax which is only paid by a relatively small number of people. During the budget, the Chancellor announced that the current IHT thresholds will remain unchanged until April 2030. Therefore, the standard nil rate band, i.e. the point at which a taxable estate falls within the scope of inheritance tax, will remain at £325,000. The additional nil rate band for residential property, when passed on to children or grandchildren, will also remain fixed at £175,000, with tapering of this relief continuing to apply once the value of an estate exceeds £2 million. This means that a married couple with children will continue to be able to potentially pass a combined estate with a value of up to £1 million before any inheritance tax liability will arise. However, there was some bad news for business owners and for farmers. That's because the availability of agricultural property relief and business property relief will be revised from April 2026. These reliefs currently provide up to 100% relief from IHT for agricultural assets and qualifying business assets. Under the new rules, 100% relief will still be available for the first 1 million of combined qualifying agricultural and business property. However, the relief will be restricted to 50% thereafter. Furthermore, the rate of business property relief that was available for shares listed on growth markets such as AIM will be reduced from 100% to 50% in all circumstances. With regard to pensions, most of the feared changes, such as the reduction to the 25% tax-free lump sum, didn't appear, which was good news. However, we did see a change to the IHT position for unused pension funds and for death benefits, which currently enjoy exemption from IHT in most circumstances. This exemption will be removed from April 2027, although it should be noticed that the spousal exemption will still be applicable, so pension funds can still be passed on to a spouse. As expected, the Chancellor confirmed that the inheritance tax regime for non-DOMs will be moved to a residence-based system from April 25. This change, as well as others that specifically impact non-DOM individuals, will be outlined later in this presentation. For VAT, as was expected, we received confirmation that private school fees will be subject to 20% VAT from January 2025. This legislation applies to the schooling of children who come within the UK's compulsory school ages, so those with nursery classes provided at private schools should not be affected. However, private sixth form colleges are captured if they provide full-time education to pupils under the age of 19. You should be aware that there's anti-forestalling legislation which will apply to payments made after the 28th of July 24, which is aimed to prevent a school from avoiding these VAT charges for terms starting on or after 1st of January 2025. There was also bad news for employers. Currently, employers pay national insurance contributions at 13.8% on employees' earnings exceeding £9,100 per year. However, the rate will be increased to 15%, and the threshold at which contributions will apply will be decreased to £5,000 per year. To protect smaller employers from these changes, the employment allowance, which allows employers to offset up to £5,000 against their total NIC bill, will be increased to £10,500 per year from April 2025. In addition, the current £100,000 threshold will be removed, meaning that eligibility will no longer be restricted to employers with annual NIC liabilities of £100,000 or less. Under current rules, it should be noted that secondees to the UK from Australia and their employers will continue to be exempt from national insurance for the first 52 weeks of their secondment here in the UK. That was a broad summary of the main tax changes that were announced in the budget. What I'd like to do now is, in advance of Adam talking about the changes for the non-dom regime, I just would like to lay out the current rules for context so that they can be understood fully. So, under the current regime, residence and domicile are key concepts in UK tax. Residence is important because it determines the extent to which an individual is liable to UK income tax and capital gains tax. So in general, a UK resident is taxable on their worldwide income and capital gains. However, a non-resident is only taxable on their UK source income and will only be subject to capital gains to the extent that those gains relate to the disposal of UK property or assets used in a UK trade. The UK has a statutory residence test, which is applied on an annual basis to determine an individual's residence position. The test considers both the amount of time an individual spends in the UK and also their connections to the UK. It has three parts. Firstly, the automatic overseas test, which an individual, Firstly, the automatic overseas test, under which an individual will not be UK resident if they weren't UK resident in the previous 3 years and spent less than 16 days in the UK, or if they were UK resident in the previous 3 years, they spent less than 46 days here, or if they work full-time overseas and spend less than 91 days in the UK, of which 31 days or less were UK work days. If the automatic overseas tests aren't met, then we would generally look at the automatic residence tests. Under this test, an individual will be considered UK residents if they are present for 183 days or more, if they have their only home here in the UK, or if they work full-time in the UK over a period of 365 days. If none of these tests are met, then an individual will be resident only if they meet the sufficient ties test. The sufficient ties test considers both the number of days spent in the UK and an individual's ties with the UK. And in short, the more ties an individual has with the UK, the fewer days under the test they can spend here before they trigger UK residency. Residency is usually determined for a tax year as a whole, but it is possible to split the year into periods of UK residence and non-UK residence if an individual comes to the UK or leaves the UK partway through a tax year and meets certain conditions. It is also possible to be resident for tax purposes in more than one country at the same time. This is known as dual residence. A person who is resident in both the UK and another country should establish whether there is a double tax treaty between the UK and that country, and if so, the treaty will normally set out how income, gains and profits should be taxed in those jurisdictions. In our experience, Australians can often fall within this category because of the likelihood of them remaining residents under their Australian tests. For a period of dual residence, Double taxation agreements are particularly important in resolving any double taxation issues which may arise. And when interpreting a double tax treaty for dual residence, you need to work out which country you're a resident for the purpose of the treaty, and that will typically override the domestic position. Domicile. Domicile is also crucial in determining an individual's tax obligations, particularly their exposure to UK inheritance tax. An individual is normally domiciled in the country in which they have a permanent or natural home, or where they have a settled intention to permanently reside in the future. For tax purposes, there are several types of domicile status, including domicile of origin, domicile of choice, and deemed domicile status. An individual acquires a domicile of origin at birth, which is typically the domicile of their father. A domicile of origin is very challenging to change, and it requires evidence of a permanent or deliberate intention to abandon the previous domicile and acquire a new one. A domicile of choice can be acquired by demonstrating a clear intention to establish a new permanent home in another country. The intention should be accompanied by actual physical presence and residence in that country. Unmarried children under the age of 16 cannot acquire a domicile of choice. However, they will acquire a domicile of dependence, which usually mirrors their father's domicile position. Finally, the concept of deemed domicile was introduced to prevent individuals from avoiding inheritance tax by leaving the country permanently but retaining significant ties here in the UK. So, under UK law, an individual is considered deemed domiciled if they have been resident in the UK for at least 15 of the previous 20 tax years. An individual who is neither domiciled nor deemed domiciled in the UK can currently benefit from favourable tax status in relation to their UK tax affairs. Firstly, the status entitles a UK resident individual to benefit from the remittance basis of taxation for their offshore income and gains. UK residents are taxable on their worldwide income and gains on an arising basis. This means that their income is usually taxable when it is paid, and capital gains are usually taxable when a disposal occurs. However, UK residents with non-UK domicile status are eligible to pay tax on the remittance basis, whereby their overseas income and their overseas capital gains would be considered outside of the scope of UK tax, provided those funds are not remitted to, i.e. brought to or otherwise enjoyed here in the UK. The remittance basis is available for up to 15 years of UK tax residence. It's broadly cost-free for the first 7 years, although it does require foregoing certain tax-free allowances, including the annual exemption for capital gains and the personal allowance for income tax. However, after 7 years of residence, a significant remittance basis charge does apply if taxpayers wish to access the facility beyond this point. Individuals who are resident but are not domiciled in the UK and undertake duties of employment both in the UK and overseas under a single employment contract can also benefit from a favourable tax relief known as overseas workday relief. In brief, OWR allows an individual to apportion their employment earnings between UK and overseas duties. Provided the remittance basis is claimed, an employee can exclude that portion of their earnings that relates to overseas duties from UK tax. However, this does require an employee to ensure that those earnings attributable to overseas duties are paid offshore and are not subsequently remitted back to the UK. OWR is available for the first 3 years of UK tax residency, and that includes any split years. UK inheritance tax. So inheritance tax is payable on death on the value of an individual's net assets above the available nil rate band. The current rate of IHT on death is 40%. IHT at 20% is also payable on certain chargeable lifetime transfers such as transfers into a trust. If an individual makes a transfer which isn't immediately chargeable, for example, a gift to an individual, then it may become chargeable on death if the donor dies within 7 years. Non-DOMs are only chargeable to IHT on chargeable lifetime transfers of UK assets or assets situated in the UK on their death, such as UK residential property. Overseas assets are excluded when considering the size of a non-DOM's UK estate. However, once a non-DOM becomes deemed domiciled, they become liable to UK inheritance tax on their worldwide assets unless this position is overridden by a tax treaty. Deemed domicile status falls away for IHT purposes only once an individual has been non-UK resident for more than 4 consecutive years or has permanently left the UK and established a domicile of choice elsewhere. Individuals with a UK domicile of origin at birth who have subsequently departed the UK and acquired a new domicile of choice will reacquire their UK domicile for income and capital gains tax purposes should they subsequently return to the UK, and for inheritance tax they will reacquire that UK domicile status if they return to the UK for more than 1 tax year. Trusts. Trusts are mainly used to pass assets and wealth down through the generations. As with individuals and companies, the extent of a trust's liability to UK tax is dependent upon its resident status. A trust which is UK resident is liable to UK income tax and capital gains on its worldwide income and gains. If the trust is not UK resident, its liability to income tax is restricted to its UK source income, and its liability to capital gains tax is broadly restricted to interests in UK land. A trust liability to inheritance tax is not determined by residence, but by the domicile of the settlor and where the trust property is situated. Therefore, since non-resident trusts can be used to escape UK taxation, there are extensive anti-avoidance rules to prevent their abuse. So, where a UK resident settlor creates a settlor-interested trust, i.e. one in which they or their spouse or their children can benefit, they will become personally liable to income tax or capital gains tax in relation to the trust's income or gains, even if they don't receive a physical payment from the trust. Previously, non-DOM settlers could use the remittance basis to avoid UK tax on foreign income and gains within a trust. However, non-DOM settlers who become deemed domicile lose the option of using the remittance basis. Therefore, without intervention, they would become liable to tax on all income and gains within a settler-interested trust, including its foreign-sourced income and gains when their status changed to deemed dom. So at the time, there was fear that this could lead to an exodus of non-DOMs from the UK, and therefore trusts created by non-DOM settlers before becoming deemed domiciled were protected from these rules. Separately, for inheritance tax purposes, overseas assets held in trusts are considered excluded property if the settlor was not UK domiciled at the time the property was settled into the trust. Provided that settlor has a non-UK domicile of origin, the settled property remains excluded if the settlor later becomes domiciled or deemed domiciled for IHT purposes, or if the beneficiaries of the trust are UK domiciled, or indeed if the trustees are resident in the UK. That concludes my portion on the latest budget updates and also the background of the current rules for non-UK domiciled individuals. Therefore, I'd like to now pass you over to Adam, who's going to chat you through what the new changes are and how they should work in practice.
Right, thank you, Dan. So the changes to the non-dom regime have come into effect, well, they've come into effect from the 6th of April 25, and what's been announced is much in line with what was anticipated. So over the following slides, I'll summarise the key rules and highlight some of the changes between the rules that Dan has talked about. It's important to note that with tax legislation, the devil is in the detail. And with that in mind, the Revenue published over 100 pages of draft tax legislation in relation to these non-dom changes alone. So there's a lot of information to go through. We're not anticipating material changes from what has been announced, but it's worth keeping in mind that the rules could change, and where appropriate, you may need to seek professional advice. But let's get on to the first slide. So the main things that we're going to look at in relation to the non-DOMs is the implementation of a 4-year foreign income and gains regime. So that's to replace the remittance basis of taxation. Changes to the overseas workday relief. There's a CGT rebasing facility. There's a temporary repatriation facility. Changes to inheritance tax. So this domicile concept, as it's being removed, is going to change the way the inheritance tax is calculated. And also we'll talk briefly about trust protections. So if we could have the next slide, please. So foreign income and gains. So from the 6th of April 2025, broadly, all UK tax residents will be taxable in the UK on their worldwide income and gains. You'll get a credit for any taxes that you paid overseas, but generally you'll pay UK taxes unless you qualify for the new FIG regime. So the FIG, foreign income and gains, you're a qualifying individual if prior to your arrival in the UK, you have been non-UK tax resident for at least 10 years. So that 10 years is determined under statutory residence test. But if you've been non-resident from arrival in the following 4 years, you can benefit from this regime. The regime will allow you to exclude certain foreign income and gains from UK taxation if you make an election for that regime to apply. The type of income that you can exclude is very similar to what one would have excluded under the old remittance basis. So it will be things such as foreign dividends, foreign interest, sale of foreign assets, profit on overseas rental properties, foreign trades, etc., as well as capital gains on non-UK assets. It's worth noting that these rules do not cover gains on offshore life assurance policies. So these are sometimes used as investment vehicles to roll up investments. And that is common also with the former remittance basis rules. It also does not include foreign employment, which is covered by the overseas workday rules, which we'll come on to in a little while. In order to claim the remittance basis, you need to file a self-assessment tax return, and you need to make a claim on the anniversary of the 31st of January following the tax year. So the UK tax year runs to the 5th of April, and the election to claim this basis is therefore, if your year end was say the 5th of April 2026, then the time limit for claiming this is 31st of January 2028. So that's a considerably shorter time frame than what you would have had if you were claiming the remittance basis. So you need to, if you come to the UK and you're intending to claim this, you need to make sure you register with HMRC fairly promptly in order that you can claim these reliefs. Claims can be made for income tax, capital gains tax, or both. Where a claim is made for either or any of these, you will lose your tax-free personal allowance. So currently the tax-free personal allowance is around £12,500. So if you claim this fig, you're going to have an additional UK tax liability of about £5,000. So it's a case of sort of crunching the numbers. Are you saving more than £5,000 by claiming this fig relief? On that point, it's also worth noting that if you earn over 100,000, your personal allowance is clawed back by £1 for every £2. So such that by the time you're earning around 125,000, you wouldn't get a personal allowance anyway. And at that point, you're probably better off claiming the fig. Unlike the remittance basis, where you simply tick the box to say, I'm not telling you anything about my offshore income and gains, if you claim this relief, you have to quantify it. You have to report it on your tax return and let HMRC know what it is, albeit it's not taxable. Um, Again, unlike the remittance basis, this time you can bring the money into the UK, spend it, enjoy it how you wish, whereas the remittance basis previously required you to keep that offshore. If I could have the next slide, please. So overseas workday relief, the existing regime is replaced by a potentially simpler regime. It's extended by a year. So formerly you could only claim this relief for 3 years, and now it's extended up to 4 years. In essence, this applies where you have an employment and you perform some duties outside the UK. And it doesn't matter who your employer is. You can have a UK employer or a foreign employer. It doesn't matter who benefits from the economic activity. Overseas duties are defined by where you as the employee are physically undertaking those duties. So if you're outside the UK, that's an overseas duty. The way it typically works is you look at your earnings for a year, you pro rata those earnings and discount the overseas element from UK taxes. Historically, there was a requirement to have this money paid to an offshore bank account, which was quite problematic. Now the monies can be paid into the UK. On the downside, where it's slightly more restrictive than the previous relief, is there are limits on what you can claim. So there is a limit of up to 30% of duties or 300,000, whichever is the lower. In practice, I think these restrictions are most likely to impact people who have duties where everything's performed overseas, such as foreign directorships. As I noted, usually you would split your earnings based on a work day where you're working in the UK or overseas, but if there's another appropriate way of doing that, you can do so. The legislation allows what they call a just and reasonable apportionment. As with the FIG, you lose your personal allowance if you claim this relief. So therefore, if you're earning less than £100,000, again, you need to do a calculation to see, are you going to benefit from claiming the overseas work days? Typically, you claim the relief on a tax return. So you'll need to file a tax return at the end of the year, and you'll need to keep detailed records of your overseas travel in support of your tax return in case you get an inquiry. It is also possible for your employer to approach HMRC and get authorization to restrict the tax deducted under payroll based on an estimate of overseas duties. So you get the cash flow benefit throughout the year. You still need to file a tax return. Care needs to be taken when you've got earnings that cross tax years, such as calendar year bonuses. You may need to claim the overseas workday relief in 2 years. You certainly don't need to claim it every year that it's available. So you do this where it makes sense to do so. If I could have the next slide, please. So CDT rebasing. From the 6th of April 2025, everyone who is liable to UK taxes on their worldwide income and gains will be subject to capital gains tax. So that will include individuals who either don't qualify for FIG or for whatever reason choose not to benefit from that status. These individuals can rebase their foreign assets, and the key conditions there are on the slide. In essence, the concept of rebasing means that for tax purposes, you treat the base cost as its market value on the 5th of April 2017. And that date, initially it was published to be April 2019, so they brought it back to 2017, which I think is quite useful in some respects in terms of its proximity to the pandemic and market values of stocks and shares. One of the real sort of noteworthy conditions is this concept of having made a claim for the remittance basis. So if you've claimed the remittance, but you have to have claimed the remittance basis in order to benefit from rebasing. Now, a claim for the remittance basis is not automatic. So if you had the benefit of the remittance basis because your foreign income and gains were less than £2,000 in any year, you haven't actually claimed the remittance basis. So there is an opportunity now, if you've never claimed a remittance basis, to either make a claim for the 23-24 tax year or the 24-25 tax year. And this may require you to generate foreign income and gains of over £2,000 so you can actually make this claim, but it may be worthwhile if this then allows you to claim rebasing. So there's a good opportunity here to rebase assets, but you have to have claimed that remittance basis. And if you haven't, it's worthwhile looking at that now to see if there's an opportunity to do so. If I could have the next slide, please. So the temporary repatriation facility. So under the old remittance rules, in order to benefit from the tax savings, you had to keep the money outside the UK. If you bring that money into the UK, it becomes taxable, and that remains the case. However, for a window of up to 3 years, they're going to allow you to bring that money in and pay a one-off tax liability. So in the first 2 years, that tax liability will be 12%, and in the third year, i.e. the year ended 5th April 28, it increases to 15%. Currently, there is no expectation that they will extend this facility beyond 5th of April 2028. You won't get a credit for any foreign taxes. So if you pay taxes overseas, that's not going to reduce the 12 or the 15%. Equally, if you've paid the remittance basis charge at any point, you won't get a credit for that. You need to do an analysis of all the monies that you're bringing into the UK, and it needs to be reported on your tax return for the relevant year, and the tax is paid on the 31st of January following that year. You don't have to bring the money into the UK, but obviously the fact that you're paying this charge is an indication that you will be bringing it in at some point in the future. They've introduced a slight relaxation on these rules where if you don't know the source, the origin of the funds, you can just treat it as taxable. So income capital gains are going to be taxable at 12 or 15%. And if you have a mixed fund, which might include capital or income, and you just cannot quantify it, and typically you see this with investment portfolios where they churn stock and various dividend payments, etc., where you cannot spend the time or get the analysis to work out what is taxable and what isn't, they will generously allow you to pay 12% on everything and bring the whole amount in. In practice, I think we might see some people doing that. If I could have the next slide, please. So inheritance tax, this is really one of the most interesting points I think have been making a lot of people nervous, particularly as currently Australia don't have an equivalent tax. So just to reiterate some of the points that Dan made. So under UK rules, IHT is usually payable on the value of a deceased estate, but may include transfers in their lifetime, such as setting up a trust or making transfers to a company. Broadly, for assets within the scope of IHT, the tax payable is 40% of the value of the chargeable estate above 325,000. UK assets are within the scope of IHT regardless of the residency or the domicile position of the owner. This has not changed. So if you own UK property, that is within the scope of UK inheritance tax if you own it on death. From April 25, an individual will fall within the scope of inheritance tax on their worldwide assets where they have been UK tax resident for 10 out of the last 20 years. Further, if the individual leaves the UK, they'll be liable to UK inheritance tax for up to 10 years. This is known as the tail. The tail will reduce if the individual was UK resident for more than 10 but less than 20 years, such that if you were resident between 10 and 13 years, the tail reduces to 3 years. Thereafter, it increases for 1 year for each additional year of residency. So as an example, if you were resident for 15 out of 20 years, on leaving the UK, the inheritance tax tail is 5 years. If you were resident for 17 out of 20, the tail is 7 years. They're going to bring in some transitional rules whereby if you leave the UK before the 5th of April 2025, you will not be caught by these rules. Although technically you may have been here for more than 10 out of 20 years, you are not going to be caught if you are non-resident by 5th of April 2025. There's an interesting concept in UK inheritance tax which has survived these changes, where on death, if you leave your assets to a surviving spouse who shares the same inheritance tax profile as you, you will be exempt from inheritance tax on that first transaction. So essentially, it defers the liability until the death of the surviving spouse. Now, there is an opportunity, because you may have a mismatch of situations here where one spouse is caught by UK inheritance tax by virtue of having been here for 10 years and the other isn't. And in those circumstances, they wouldn't qualify for this interspouse exemption. So there is an opportunity to make a one-off irrevocable election for the surviving spouse to treat themselves as UK domicile, such to benefit from that IHT exemption. The downside of this election is that even if they leave the UK, or perhaps they were never in the UK, that IHT tail will be 10 years. There are some winners under these new changes. So anyone who was born in the UK, who may have moved overseas, and I see quite a lot with my Australian clients, they were born here, they moved to Australia, as young adults, and they've come back to the UK, perhaps when they've retired. And those individuals under current rules could be subject to UK IHT in as little as 2 years. Under the new proposals, they will not be. So they will get the benefit of this 10 out of 20 years. So those individuals, if you were born in the UK and you're coming back here, the position is much better, considerably better. If I could have the next slide, please. So I don't want to spend too much time on this because, frankly, it's a presentation in itself, and it may not be relevant to too many people on this call. Broadly speaking, if you are the settler of a trust and you retain an interest in that trust, you are going to be taxed on the underlying income and gains of that trust. And that's contrast to the current rules where those monies can roll up in the trust without a UK liability. The other important point with trusts, as Dan mentioned, is previously IHT planning around domicile was to take your foreign assets and put them into an excluded property trust before you'd been here for 15 years. And then forevermore, those assets were protected from UK IHT. Unfortunately, that will not work anymore. So if you have a trust, the test will be, it will look at the position of the settler on death. If that person meets the 10-year residency test, then the assets within that trust will be subject to UK inheritance tax. I think that's quite an important point for anyone who's got trusts, and we really need to review those before 5th of April. If I could have the next slide, please. So just some practical points here, really. So if you're thinking of coming to the UK, it may be worthwhile trying to delay your arrival until after the 5th of April 25. This is going to maximise the amount of the FIG relief you can get, and also push that inheritance tax liability further down the line. Now, with the residency test, which was outlined earlier in the presentation, doesn't necessarily mean that you're resident from the date of arrival. So it could be, for example, you come to the UK in the middle of February, but you won't trigger tax residency until 6th of April following. So a little bit of planning around timing, I think, is worthwhile, and it may just be the case of delaying your arrival by a month or so to really maximise what reliefs are available. In a similar vein, if you're thinking about leaving the UK, as much as it pains me to say it, it might be better off leaving before 5th of April 2025. Again, the the statutory residence rules that we have in the UK means that you can determine your position with some accuracy, that you cease to be resident. So the rules in the UK are very prescribed, unlike the Australian rules, where it's very much intention based and subjective. This is a box ticking exercise. Um, Good news again, there's no exit charge. There was a lot of speculation that they would try and pin an exit charge on people who tried to leave the UK. Fortunately, they've decided that that just would not work, would not be practical. Um, if you are dual resident, so if you're resident in Australia under the subjective residency rules and you're resident in the UK, it is really worth looking at that tiebreaker. So the tiebreaker in a double tax treaty says you are resident where you have a permanent home or where your social and economic ties are closer. So it's a subjective test. Almost where would an outsider say you live? If you are Australian resident under that test, then this will give you a lot of protection from income tax and CGT on your non-UK assets. It doesn't extend to IHT, but it's certainly worth considering in terms of income tax and CGT. If you do want to do this, you need to file a tax return and you make a claim on your tax return for this status. As noted earlier, consider the benefits of the remittance basis. So if you are within time to make a remittance basis claim, indeed, for the year ended 5th April 25, the current tax year, you could make a remittance basis claim up to 4 years after. So it's really worth looking at what are you going to benefit from a capital gains rebasing? Do you want to make that remittance basis claim? Another bit of current year planning is in relation to, is it worth claiming the remittance basis in the current year and shelter, say, foreign dividend income or a foreign capital gain, so you don't pay tax at 40 or 20, 24%, to instead bring that money in after 5th of April and pay 12% under the repatriation facility. So a little, depending on what your profile is, a little bit of planning there. Similarly, if you've got control over the timing of payments, can you have a dividend paid before 5th of April or after 5th of April if you benefit from FIG? If you've got capital gains, can you realise a gain now or should you realise it after and benefit from the rebasing? So there's a lot of opportunity there in terms of getting your timing right. Going forward, if you are going to be subject to UK taxes, it's worthwhile considering sort of investment opportunities and can you defer roll up income? So for example, could you invest in an insurance bond and defer the tax liability over a number of years? As I said, for those who are going to be caught by IHT planning, so those who for IHT who can't move overseas within the 10 years, it's worthwhile looking at your IHT position, looking at the family arrangements and seeing what planning you want to put in place. Do you have a will? Should you have a will? Should it leave assets to the spouse to avoid immediate UK inheritance tax? Can that will include a trust that then dictates where those assets are left to thereafter? All sorts of planning. If you are going to leave the UK and you're worried about this tail, you can look at fixed term life assurance. So fixed term life assurance is much cheaper generally than whole of life. You may be able to get life assurance to cover you for a 3-year tail, a 7-year, or even a 10-year tail. And finally, just a reminder on trusts. The effectiveness of trust for UK purposes is virtually non-existent. They do serve other purposes, but it's absolutely worthwhile reviewing the trust position before 5th of April 2025, deciding what action, if anything, should be taken. I think, yeah, that largely sort of sums up the key points. As you'll appreciate, it's draft legislation and you've got to look at the details specific to each of you. But if I could open the floor to some questions now.
Yeah, thank you, Adam, for that really detailed presentation. It was great to get an overview, obviously, of the outcomes of the UK budget, but also more in detail about inheritance tax and then changes to the non-dom. I can see we've already had a couple of questions come through. So, and like I said before, if you guys just want to submit these questions using the Q&A function, the chat function's disabled. So just use the Q&A function and we will get to those questions. So I can see the first one is from David, and he said regarding inheritance tax, if I have been a resident in the UK for 10 years and 6 months, then relocate back to Australia and become an Australian tax resident, is the tail 1 year or 3 years? So
Yeah. Well, if this is a repatriation after April 2025, then I think the tail is going to be 3 years, which is in line actually. If you even if you leave before then, under the existing rules, the tail would also be 3 years. So it's a minimum of 3 years under the new rules, which is in line with the old rules. So
okay. And then we have another question from Tom, and he said, would a settler who is also a discretionary beneficiary in a discretionary family trust settled in Australia, a settler interested in non-UK resident trust? If so, are they liable for tax on all of the trust's income or just the distribution made to the settler as a beneficiary? That might be
yeah,
a specific one.
yeah. I mean, it's always worthwhile looking at the trust deeds and doing the analysis on this. But very broadly speaking, a settler interested trust, or where your family or your dependents can benefit from that trust is settler interested, and therefore it ordinarily I would expect that to be within the scope of UK taxes, but I think it's worth looking at that trust deed in a bit of detail.
Yeah. And for that detail, just for everyone on the call as well, in our thank you email, we'll provide the details of both Adam and Daniel. So if you had any follow-up questions, you can also reach out to them directly. But we have had another question come through. So from Emma, for those on the youth mobility visa, the Tier 5 visa, are we able to claim any of the tax offsets or subsidies?
Um, Generally, no. The UK is not particularly generous in terms of tax reliefs that one are able to offset against income tax, other than the reliefs that we briefly outlined today. So I think the answer is no. Um, but I think, yeah, if you're able to sort of organise your position such that potentially you could work overseas, then there may be some tax savings there that you should qualify. And certainly in relation to foreign income and gains, you should be in a position where you can shelter that from UK tax.
Yeah. And then another question come in from Peter. He's saying, an Australian living in the UK, can I return to Australia and still transfer my work pension pot to Australia and avoid inheritance tax?
Um, the answer is yes, potentially if the scheme provides for it. So there are rules where you can transfer your pension to what they call a qualifying overseas retirement plan. So you need to find somebody who's going to accept that plan in Australia, and they need to stay compliant with the UK rules for 5 years. So whether or not it's worthwhile is going to depend on the value of the pension pot. On pensions in general, it's worth noting that even after you've left the UK, those pensions will be protected funds for tax purposes. So it means you won't be paying in the UK income tax on the profits of that fund. And at the point you come to draw those funds, if you do, currently under the UK Australia Treaty, those funds are only taxed in Australia if that's where you're resident. Um, there is a slight complication there in terms of any lump sum payments you might take, because generally the UK will allow you to take 25% tax free, but I don't think in Australia they recognise that.
Okay. I can see someone has their hand up. So if you just wanted to, again, use the Q&A function, we can get to your question. But we have had someone else also submit one. So he just said, regarding the UK pension transfers to Australia, you need to be over 55 years old. Maybe that's more of a comment or over a question.
Yeah, you've got to watch out for you can have an exit charge in an unauthorized exit charge, so it needs to be done
Yeah.
with the benefit of good advice.
Someone else said on tax residency, automatic residence, full-time work for 365 days. This might be quite specific. I arrived in November 2023 by the end of financial year 23-24. I haven't worked full-time for 365 days. Now I have been working for 365 days. Does the rule date back to my arrival date in November 23 so that the financial 23-24 year would become tax resident?
Yeah.
Now, again, that might be a bit specific, but
well, no, it is, but I think the answer is yes, it will. So that there's various legs to this residency test, and if you're not caught by one, you're probably caught by another one. So with that amount of time in the UK, assuming you've been in the UK physically here for the majority of the time since the 1st of November 23, I would suspect that you are resident, regardless of potentially not meeting that full-time working in the UK test. You might be dual resident, though. You might be resident in Australia as well, which might mean you can benefit from that treaty exemption we spoke about.
Okay. I don't think we have any more questions. I know there's been some comments still been posted around the pension. But I don't think there's any more questions. So in that case, oh, here we go, one more. How should tax be paid for transferring pension funds to the UK?
Forgive me, repeat that one, sorry.
How should tax be paid for transferring pension funds to the UK?
I think it depends. If this is a withdrawal of a pension, then and you are UK resident, you don't benefit from this fixed status, then that pension will be taxable here by virtue of the double tax treaty. You would normally file a tax return to pay those taxes. Taxes are payable on the 31st of January following the year end. But yeah, again, with pensions, it's worth there's a slight difference between the UK pensions and the Australian scheme, so it's worth looking at that detail to see if that is indeed a pension as per the treaty and that it's taxable here.
Yeah. Okay. Well, I don't think we've got any more questions, but questions are a sign of engagement, which is great. And I did notice throughout the whole webinar that we had about 80 people throughout the whole time, which is great. So obviously, like I said before, this is of great interest to all our members. So we'll definitely make the slides and webinar available and send through the contact details for Adam and Daniel for any follow-up questions. But thank you again to HW Fisher for partnering with us on this webinar and all your valuable insights and contributions. And yeah, we look forward to staying in touch and we'll see you soon. But thank you again for joining. Yeah. Thanks,
Right,
everyone.
thank you.
Thanks.
Thanks, everyone.